Okay, very, very happy to be here with all of you, and I know we have quite a few offices who are live streaming as well. Just quick correction, my name is pronounced Shubhi, so it's okay. And I have been with Google or Alphabet now for 7 months. And it is this is the first one I'm hosting actually since I got here. So I'm very pleased to have two very esteemed guests joining us from Charles Schwab. First one in a minute here, as they walk in, Terri, Kallsen. Ann Sonders. Both of these women are going to spend the next 45 to 50 minutes with all of you to really think through how we should, as women and also men in the audience, think through investing, so investments, and why we should own that decision. So as a woman, I genuinely believe that we own all our decisions, and part of owning our decisions is also the investment decisions. We also have quite a few offices from around the globe that are live streaming, so hello to everyone. The format of the next 45 to 50 minutes is going to be, I'm going to kick it off with a few questions so we all can get to know Terri and Liz Ann a bit better. We have a bunch of questions, obviously, on the dory. We'll take some of those. But of course, we want tremendous audience participation. I know none of you guys are shy. So please make sure to ask all your burning questions to Liz Ann and Terri. Okay. Any questions before I get started? Great. So welcome.
Thank you very much. Thank you.
All right. I think one of the first questions that we have is we want to get to know you a little bit better. So it would be helpful to just understand, how did you both get started in this business? What attracted you to investments, and how did you get into?
Sure, I'll start out. First of all, it's a pleasure for me to be with you here today to talk about financial planning and investing. I've been in the industry over 25 years, and when I look out in the audience, I feel really old. So, but it's been a very exciting industry to be in. And one of the reasons why I came into financial planning and financial services is I believe it's one of the ways that we can truly help people. And when you think about people and the different life events that they go through in terms of going to college, graduating from college, buying a home, selling a home, thinking about retirement, getting married potentially, having a baby, getting a divorce, planning a legacy, all the different life events that people go through. There's lots of emotion involved in those, but there is always a financial implication for many of the life events that we go through. And so as I went through the last 25 years and I worked with people, not necessarily people of wealth, but people who are making a difference each and every day in their day-to-day jobs, they're coming across these life events that we go through each and every day. And there's so many financial implications. And so I came into the industry having all my different licenses, and I'm a certified financial planner. But it was really to try to help people think through the various options they have so that ultimately they can achieve their long-term financial goals. And as we go through these life events in each and every stage, there are implications both in the short term and the long term. And so I enjoyed that particular part of the analytics of the financials, but really serving people and their needs. And that's why I came into it. Now, I can give you kind of my resume and my background and whatever certifications I have, but I'm not sure that's the most important thing. I think the most important thing is that this is a way to really help people make better decisions to achieve their goals. And you know, my undergrad in college was in chemistry. And so you might think, well, how did you end up here as a certified financial planner? And I run the retail business for Charles Schwab. So we have over 300 branches across the country, about 6,000 employees. Our stock plan services is obviously managed here at Google, and we're grateful for that relationship that we have. But you know, I really learned through the analytics of science and chemistry that I enjoyed it very much. But my first job out of college was at 3M in St. Paul, Minnesota, which is a long ways from here. I'm from the Midwest. But it was a company of 80,000 employees, international, and I loved it. I loved the research I did, but I missed the people part. And so then I went on to graduate school, got my CFP, started understanding financial products, got all my licenses, started to sell, learned how to help families through so many difficult and really rewarding decisions, and then just kept going. And I joined Charles Schwab, and I find this company to be so innovative and to have so much energy and creativity to be able to help people in their financial services. And so now, anytime as a client, an individual client, and you interact with Schwab, you might want to write down my name, because if it's a good experience, I'd love to hear it. If it's a bad experience, I'd love to hear it. But anytime we work with individual clients, I'm generally involved in some way, shape, or form. Go ahead.
So Terri said you feel old. I'm 30 years in this business, so I feel older. When I got out of undergraduate school, it was 1986, and I would say in the mid-1980s, if you thought about an industry that was the place people wanted to go when they graduated college, much like Silicon Valley is now for college graduates, it was Wall Street. It was the original movie Wall Street with Charlie Sheen before Charlie Sheen became Charlie Sheen now, and Michael Douglas. And I mean, it was the place to be. It was exciting. It was where the opportunities were great. It was just everything that I think is represented by Silicon Valley now. So it was not so much a no-brainer, but that was a natural gravitation for me. Undergrad, I went to University of Delaware. I knew I wanted to work in New York City. I interviewed at a number of different firms across industries, not just Wall Street, but there was always something that had me gravitate toward Wall Street. And I had an interview at this firm called Zweig Avatar, and I had been familiar with Marty Zweig, the founder. He was very famous at that time, and did television, which was in its infancy in terms of financial television, but on a show that I ended up getting involved with called Wall Street Week with Louis Schukaiser that had been on since the 70s. So it was kind of cool to work for someone famous in the business. And then I went to business school at night immediately after starting. It was fully paid for by the company, and I went to what is now called the Gabelli School of Business at Fordham University. So I would leave the office and I would walk to classes and went at night. And that's where I really honed in on finance. So my undergraduate degree had been political science and economics, but I received my MBA in finance and really learned the business from working as much as from school. And started as a grunt. That was not my official title, but that's what I did. It was portfolio assistant. But I remember the first day I was asked to get coffee, and I called my parents crying. Why did I go to school for 4 years? Moved up in the ranks, and in 1999, for a variety of reasons, it was time for a change, and I joined U.S. Trust, which 10 months later was acquired by Schwab. So that's how I came to Schwab. I always like to say I was adopted by the parent company. And more than the first half of my career, I was a bottoms-up stock picker. So I analyzed companies. I was a portfolio manager. But I was always much more interested in the top-down, interpreting big picture macro environment. And in particular, I became obsessed with investor behavior. Because I think when I'm asked about what fundamentals are most important when you're making a judgment about what's going on in the market, it's the behavior and attitudes of investors. If you get that right, particularly at extremes, and it works in a contrarian way, you can get it right most of the time. So I consider myself a student in investor psychology and behavior and investor sentiment. And for the past 17 years at Schwab, that's largely been my role as chief investment strategist, literally and figuratively flying around at 30,000 feet and trying to make a judgment on what's going on in the world. And I would say probably the best advice I ever got in terms of the nuances of how to do that was mentioning this show that sadly probably nobody here has ever seen or would remember its head, Louis Schukaiser, but he was an icon in the business. And the first time I was on his show, which was the only show for 20 years on finance and economics and Wall Street, he asked me whether my parents were still around. It was 15 minutes before going out to do this on-camera interview with him. And I said, yes. He said, are they in the business? And I didn't know whether he meant TV or finance. I said, well, television? He said, no, are they finance people? I said, no, far from it. And he grabbed me by both of my shoulders and said, do me a favor, when you come out here and do the interview, get them to understand what you're talking about. So I always took that to heart because I think there's so much that's complex in the world. If you can explain it in fairly simple terms, I find that the people who come up and say, I really appreciate that, not just me, but all of us at Schwab try to put things in understandable terms, whether we're writing or speaking. More often than not, it's actually people on the more sophisticated end of the spectrum. At 30 years in the business, I'm completely turned off by somebody who gets up in front of a room and just wants to sound like the smartest person in the room and throws the lingo out. So I'm an interpreter, really. That's how, when my daughter's a junior in high school now, when she was in 8th grade, I did career day at the middle school. And one of the things they ask you to do is explain what you do in terms that 13 and 14-year-olds can understand. And so I described it as an interpreter of what's going on in the world. So that's what I do now, but 17 years at Schwab, and I think that this firm has been an unbelievable pioneer, really democratized investing, and we have been at the forefront of it for 45 years, and I'm a happy employee.
Great.
And I could just add, you talk a lot about icons in the industry from the 70s, but Liz Ann is an icon in the industry right now. So I know you all.
From the 60s.
Yeah. I know you all Google, but if you haven't Googled her, she's quite amazing, and you've given a lot of great advice over the years.
Thank you.
And more to come. Thank you.
So talking about advice and what you've seen over your career, Liz Ann, how have you seen the investing needs or the style of investing for women evolve over that period? So that's sort of the first part of the question, and maybe then you can broaden it just to see how has that then, of course, broadly across the demographics that has changed.
So the one thing interesting about women and investing, and there's no hard concrete facts on this, but there's a lot of more than just anecdotal evidence that women actually tend to be better investors than men. Sorry, guys. There was a study many years ago done on investment clubs during the era where investment clubs were much more popular. I think the financial crisis and the attendant bear market, I think, convinced a lot of people that getting together over wine or coffee and picking stocks has its downside too. But women-only investment clubs versus male-only investment clubs, the performance spread was outrageously big, like 20-some-odd%. And there have been other studies showing that women tend to be longer-term focused, rely on intuition a bit more, and this is obviously totally generalizing, where men tend to be a little bit more gamblers with a bit more of a short-term time horizon. But leaving gender, well, actually, let me not leave gender aside for a minute. What we know now is that I think it's already the case that women control more of the wealth.
Yes, absolutely.
Now, I think that we just passed that sort of threshold.
That's right.
So it's increasingly important for women to be as engaged as, in many cases, men have been for a longer period of time. But I think, again, generalizing, I think the differences emotionally in women versus men can serve women fairly well in managing their money. I think that with the democratization of investing, I think that the resources, the information, the education is there to a much greater degree than it's ever been before. Ease of access to that information, the ability to take a more sophisticated approach to managing our money is there by virtue of what companies like Google do in terms of the resources provided to employees, but it's still daunting. And I think that particularly for young people, they don't quite know how to start. But when I think about when I started in the business in the mid-1980s, there was no such thing as a 401k. There wasn't the access to information and advice. You just had to say, okay, I'm going to open an IRA, and you basically had to wing it. And the resources now that are provided, not just broadly in the industry, but within companies, is extraordinary. It's just you need to avail yourself of those resources.
Yeah, I would just echo what Liz Ann said, and there's so many important data points out there, and women do control the majority of wealth now internationally, and there's a couple reasons for that, which I'm sure you're probably aware of, but more and more women now graduate from college, undergraduate degree, than than men do, but of course, this is not about women or men, it's just simply the statistic. So all the men that are watching, we want you to know that a lot of this applies to the general population as a whole. But certainly more and more women now are choosing to be single longer, be it either they get divorced or they never get married or they become widowed faster, but there is a deliberate choice to be working and single, and so they have a larger majority of the wealth, and there just are more women. I mean, that's a statistic that no one can debate. There's more women in this world than there are men, and so as we continue down the evolution, women just control more of that wealth and more of the buying power. And so the information access is incredibly important. And Lizanne, you talked about talking to your daughter and what you do, and I have similar conversations. I have 2 daughters and an older son, a 19-year-old son, a 15-year-old daughter, and a 12-year-old daughter. And when I talk about it, I talk about we do the 3 S's. And it's very simple, but we help people to spend, save, and share. Spend, save, and share, and having a plan to do that. And so when we talk about women and wealth and how they're making decisions, in many cases, in the majority of households, women are making those 3 types of decisions. And spending is as important as sharing, as is important as saving. And when we talk about saving, I'm not talking about a bank account. I'm talking about the larger picture of saving around investing. Oops, I may not be able to talk much more. This is a good way to cut me off. So someone says, take her microphone, and we're done.
Someone's got a little string on it.
Yeah, exactly. But those are some of the important concepts for both women and men to consider, but for women to realize they're empowered now because of the wealth of information, the wealth of advice, the wealth of financial planning, the wealth of understanding the long-term goals and some of the critical decisions people will make in a 20, 30, 40-year working period, right? Because a lot of us are millennials. I can't say us, but I'm talking inclusively in the room. And so many millennials will be working well into their 70s. And to think about all the different life stages that we will go through and what the financial implications of spending, sharing, and saving during that time are really important to have a plan and to consistently execute on that plan.
Do you, in your experience, see women have a different investment style versus men, for example? Do they tend to be more conservative? Do they tend to be more passive investors?
Yeah. So we do look at women and men, and what we do find for women is that they do have a longer term view. And with the longer term view, they are a little bit less risky or more risk averse. And so we do tend to find women are a little bit more conservative, a little bit more deliberate, and a greater long-term view, which tends to pay off in the long run. And many of you probably saw Chuck speak at this event, and one of Chuck's absolute disciplines is the long-term investment diversification that's necessary, and not chasing performance, not chasing a hot fund or a hot stock or a hot bond, but thinking about the total portfolio, making sure it's diverse in terms of stocks and bonds and risk and aggressiveness, but also thinking about not what happens in the next month, in the next year, especially for those dollars that are 10 to 20 years out, be it retirement or mortgage savings or any type of longer term goal, is to be able to maneuver between the ups and the downs, the swings, because all the data that Lizanne shared is long term, those investors will win.
Yeah.
And when those investors win, they have the resources to be able to achieve those longer term goals. And so it's a win-win, obviously, for the client and for the family. And women just tend to be okay with writing out the long-term diversification. But I also think men have just as much of an opportunity to do that. I'm always very careful that this is not a woman thing or a man thing. It's a societal thing. And one of the things I just wanted to emphasize too, and then you really can pull the microphone. But when Chuck was here, he talked about wealth creation. And in this country, there is fewer and fewer opportunities for real wealth creation. And so one of the ways we can actually create wealth, and I'm I'm not talking about millionaires or billionaires. If that's what you want to do, that's fine again, but how do you create that wealth? And the greatest way to create that wealth right now is obviously through equity, which you all have as Googlers, which is great, and then to have a longer term plan to diversify so you create the level of wealth that you choose to live with over not only just when you retire, but as you live day to day. And that's really important.
You know, Terri, you talked about risk tolerance and time horizon, and one of the things that I have found, and this crosses gender lines, is that too many people, investors, think that there's a automatic tie between your time horizon, i.e. your age and how long you plan to work, and your risk tolerance. And that's, I think, where investors can trip themselves up, because you might be 24 years old, you just started working, you're investing in a 401k, you've got an IRA. Ostensibly, you have a very long time horizon, which on paper suggests you should take a reasonable amount of risk in your portfolio. But if you're going to obsess over your portfolio and freak out at the first, correction in the market and a 10% drop, and then panic and sell, I don't care how young you are not a risk tolerant investor. I had the great pleasure many years ago of meeting the late great Sir John Templeton, who when I met him was in his 90s. And he was still at that age an extremely aggressive investor. Now he had a couple $1 billion, so that maybe is a factor as well, but he understood the risk. So I think that is one of the mistakes that investors make, is not truly understanding their risk tolerance and the potential mistakes that they are going to make. It has a lot more to do with your own sort of emotional makeup than it does the number of years on paper that you plan on working.
And Lizanne is so good at that. The media doesn't help us much with that.
They do not.
I think a few months ago the market was down 2%, and all the headlines was, the market's, plunging. It's all going to hell in a handbasket, and that 2% that's nothing. That's decimal dust. But one of the things I think about when I think about all of you is you've been through a 9-year bull market. 9 years. What were you all doing 9 years ago?
8 years.
8 years? I'm optimistic. Yeah. See?
It'll be 9.
Yeah, I'm always rounding up. So, but think about where were all of you even 8 years ago? What were you doing? What were you thinking about each day? And then now where are you 8 years later? And what are you thinking about? How are you managing your money? I suspect it could be very different for some of you that are millennials. Now, this won't last forever. There's one thing I know for sure, and I'm not even as good of a forecaster or prognostic as Lizanne, but it won't last forever. And so thinking about when it does go down 2%, 5%, 8%, how will you hang in there for the long term? And I care that much about each and every one of you, because it is the ability to see through that and see through the long term that will create the wealth that I believe is a part of all of our future. And if we can have that diversification strategy, we have a chance of being very successful. But it's when we react very quickly, because it will happen, that's where we run into trouble, and investing gets really overwhelming and very complex. At its simplest form, it's long-term diversification and really understanding your risk tolerance and staying in there for the long run.
It is, I think, the most important thing that we try to impart. In fact, Terri mentioned the perils sometimes of what the media brings to this picture. And I would say the most common question I get from reporters is some form of, are you telling investors to get in or get out right now? Which I both hate the question, but I also love it because I get a chance to answer it. And I try not to do it in a snarky way, but the answer is typically, well, get in and get out are gambling on a moment in time. Mm-hmm. And investing should never be about gambling on a moment in time. It should be a process over time. And so again, that's why I love the question to the extent they give me the ability to answer it.
All right.
Ali, should we take some questions from the audience?
Yeah, I can take the first few from the Dory.
Oh, perfect.
And then we can also take some live ones, but we have a lot of action on the Dory. And the number one upvoted question comes from Grace, and she wants to know if you could please provide a brief overview of investing and tips for how beginners such as herself could get their feet wet.
So I think both Terri and I have touched on this a little bit in a broad sense, in that I think the access to programs and tools and information and education even within our companies is much greater than it's ever been. So avail yourself of those, but understand that having a plan is the most important first step. I think most investors who wing it, however you define that, are not going to be as successful as those that have a plan. And because of access to asset classes and the ability to put together a truly diversified portfolio has never been greater, that's the best way to start. And then understanding the discipline that needs to be had around that plan. And once you start with a plan and you have discipline and you understand the merits of things like rebalancing, that's how you start. And whether it's using programs like, to use the generic term, Robo advice, that's one wonderful way for young people to get started. Internal programs, as I'm sure Google has. So I think, but having a plan, don't just wing it.
We have a microphone here for anyone who has any questions live. The next top rated question was on auto sale for Google stock. Is there research that shows whether it is better to use auto sale or to wait and sell shares on your own? Could any potential gains of selling on your own justify the effort to do it?
Well, I'll start out, and just each and every company has their own auto plan, and so I'm not an expert on the Google auto plan, but here's where I would start with that question. It's probably maybe a little step back in terms of what is it you're trying to accomplish with your equity compensation? What role does it play in your day-to-day life as well as in your longer-term view? 5 years out, 10 years out, what are some of the things that you want to accomplish in your life, and what role does equity comp play in that? Once you have that, then you want to start thinking about when is the right time to start actually taking those distributions and to use it as a part of a longer term plan than to think of it as a reactionary, quick cash in your pocket, not sure what to do with that. That's a more dangerous place to be. It's a fun place to be, I'll grant that. But you want to be thinking about what is your longer term plan and have the discipline to do that. Now, auto sales play a really good purpose, especially for Googlers, when I understand you're all insiders, and so you have restrictions in terms of when you can trade and when you can't. And so when you have an auto plan and you have a larger plan, then it's really important to use that auto plan to make sure it fulfills what you want to do. Because if you don't go on the auto plan, then you're subject to restrictions, as both Liz Ann and I are at times, and then you have the volatility of any particular stock, of course, and so you may miss out on the opportunity to achieve again that longer term plan. So I am in favor of auto sales if you have a larger plan and you execute on it in a disciplined manner, and you're getting the advice that you need in order to use those dollars to your benefit. And so it's really much a larger answer to probably a simple question, but I hope that you hear from me is that I'm asking all of you to think about what your plan is before you just put the money in your pocket.
What advice would you give to someone with only cash savings and long-term goals who wants to enter the U.S. market? U.S. stocks seem expensive and bonds seem risky with the record low yields and anticipated interest rate hikes. How would you enter, and with what portfolio?
So, unfortunately, my answer will be with limited specificity for some of the reasons that I already touched on. And the example that I use is that I could have one very high conviction view on what I think both the stock market is going to do and the bond market is going to do. And it could be my highest conviction view that I think stock market's going to be up, at least 20% next year, bonds will do whatever. But what I would tell a 22-year-old investor who just started, who goes bungee jumping on the weekend and isn't going to be the aforementioned panic at the first down 10%, versus what I would tell a 75-year-old who needed every dime that they had saved and they needed to earn income. So one view on the markets, two totally different messages in terms of what those investors are going to do. So therefore, I'm going to answer more broadly, some of which we already touched on, which is avail yourself of the educational resources, but most importantly, understand yourself first and your risk tolerance. I think in general, investors are well served by taking sort of a dollar cost averaging approach, certainly diversification across asset classes. Don't try to hone in and say, okay, well, the stock market looks less expensive than the bond market, so I should just go all in. All in never really works in any asset class. And on the valuation point, as far as the market looks expensive, yeah, the stock market is reasonably overvalued right now, but using a traditional valuation metric of price to earnings, the good news is earnings have just moved from negative back into positive territory. So the denominator in the equation is improving for the first time in 5 quarters. So that goes a long way of improving valuation. And in a low interest rate, low inflation environment in which we still sit, you can justify higher returns. So in terms of just what our message is right now to our investors in terms of our perspective on the broad U.S. asset classes, we actually, I personally think that this is an ongoing, what we call a secular bull market that began in 2009. I think it has a ways to go, and I think earnings will help improve valuation. And although we do think that the 35-year bull market in bonds ended, it's not likely to be a V, i.e., we've had this sort of 35-year bull market. Now it's going to come to a crashing end, and we're going to go into sort of implosion mode. We think the rise in yields will be sort of slower and steadier. So that I ended by just sort of adding our perspective on the markets, but mine or anybody's perspective on what the stock market is going to do really should have very little bearing on what anybody does with their own portfolio.
And the person who asked the question was a 21-year-old, is that right? Or not the person itself, but was the example a 21-year-old?
The first question said that she was a new grad. This last question did not leave their demographic info.
The only thing I'd add to that is, make sure you're investing in your 401k up to the match. That's critical. And make sure you know what you're investing in. Look at your portfolio. Not look at it every day, but at least be aware of what's in there and some of the decisions that you're making for your long-term view. In dollar cost averaging, I can't emphasize that enough. If you have a plan and you think about investing, time and market, again, the long-term view is always the biggest critical success factor. So the younger you can start investing, or at any time, the more that you can invest each week, each month, each year, will longer term pay off for you than just about any other category.
And periodic rebalancing. I don't think people emphasize the power of this enough. Maybe because it's not such an exciting thing to talk about on CNBC, but the way I always describe rebalancing, which is you have a plan that's an asset allocation plan where you're diversified across asset classes. You've got U.S. equity exposure, international equity exposure, fixed income exposure, maybe exposure to real estate and other alternative assets. But those asset classes are going to move in terms of prices. So your portfolio is going to change, and asset classes that have done better are going to increase in terms of their weight in the portfolio, and vice versa. And what a periodic and systematic rebalancing program does is it forces you as an investor to do what we know we're supposed to do, which is basically buy low, sell high. But when left to our own devices, we more often than not, do the opposite. It also doesn't require that you have your own view of the market or figure out which, Yahoo on CNBC is going to have the right market call. Your portfolio is going to tell you when it's time to do something. You don't have to worry about your own call on the market or anybody else's call on the market. So I think rebalancing is such an awesome tool that is built into a lot of these programs. But even investors with their money outside of things like 401ks ought to have that as part of their discipline.
I do agree, though, that there is no reason why all of us shouldn't be part of the 401k plan. So, agree. Should we take some? Oh, great.
Hi. I'm breaking the ice in the room here, I guess.
Thank you.
Hi. I'm on the Google Global Equity team. And when you spoke about have a plan, in mind, have goals in mind that is aligned with what we always try to steer people towards. But specifically, what are the starting points of planning? Because, for example, here in the Bay Area, home ownership is probably a goal for a lot of people elsewhere, but it is often intangible here in the Bay Area. So that tends to be like this common thing that's off the table for a lot of people for a while here. What are other end points that people can start to think towards, 401k being one, but what are some of the other ways that you can start crafting your plan?
Miss Financial Plan.
I'll start out, and what I'd like to do is I'd like you to visualize with me what is a financial plan. And so those of you who have your Google tablets in front of you, go ahead and color along with me. But I want you to think of a triangle, a very simple triangle of what a financial plan is. And at the bottom of that plan, the foundation in any triangle, the strongest component of any triangle, and they use it in physics all the time, is the foundation of the triangle. And that's your strongest component. And in that bottom part are your goals, your dreams, what you want to accomplish in the next 5, 10, 15 years, whatever that is, be it home ownership, international vacation, a sabbatical, buying a house, going to graduate school, whatever that is. But that's where your bottom is on your financial plan. From there, just one rung up, so visualize with me, one rung up on a triangle is how do you cover your risks, right? So we all have risks in life. We have health risks, we have life risks, we have debt risks, we have liability risks, we have all kinds of risks in life. And so that first rung above your goals means I need to make sure at least I have some of my risks at least addressed, right? So for me, for example, I am the single breadwinner of our family. I've been married, I have 3 children, my husband stays home with our kids. I have a college fund for all 3 of my kids, right? But if I become disabled tomorrow and my husband doesn't work, he stays home, I should say he works, right? But he takes care of our kids, then any college fund I had is now at risk because I'm not working and I'm not necessarily contributing to that. So I've got college up here, but first I have to cover those risks. For all of you, it might be a different risk. Just a little factoid, and I share this all the time, is anyone who's younger than 55, which is the majority of people in this room, you have a much greater risk of becoming disabled than you do of dying. And I'll move off that topic because we'd like to be happier in these conversations, but that is a reality that we live with. So you have to cover your risks in that piece. That doesn't mean all your money goes to that, it just means you've acknowledged you have some risks. From there, actually just above that rung is what's called cash flow planning. And so this is your budgeting, this is your credit management, this is your day-to-day spending and expenses, this is where you budget online and you understand where your dollars are going to, but that's cash flow planning. So you know how much money you have at the end of the week, month, year, and you know what you're saving and you know what you're not. Actually, right above that rung then, and I know this is getting long, but it's about estate planning, and that's not about trusts or bypass. It's about, do you have your powers of attorney done? If something should happen to you, do you know who would take care of you, your healthcare power of attorney, your durable power of attorney? It's really important. I know this is a young audience, but if you ever want to Google Terri Schiavo, it's a classic case of someone who had no healthcare powers of attorney, was on artificial support, and they couldn't make a decision of what to happen because no one addressed that. Really important component. Again, we'll move off kind of the morbid topic, but something that we think about when we do financial planning. From there, it's investment planning, retirement planning, and then dream and goal planning from there. So that may be that house over the long next 10 years potentially. But it's really hard to plan for that house unless you have some of these components done. And there's all kinds of examples like that. The things that you really want to do, and one of the components might be charitable giving, right? Making sure that you've done what you want to do to help others and volunteer and donate to the causes that are most important to you. Well, we create a way to do that in your financial plan. And so when we talk about financial planning, it's what are the goals that you want to achieve, and then how do we make sure that nothing gets in the way of you achieving those goals, so that you have a lockstep plan and you're talking about it at a minimum once a year to make sure, are you still on track or not? Anything you want to add?
No, that was fantastic. I'm going to steal that.
Well, if anyone wants to share with me their triangles, I'd love to see it.
Hi. Can you talk a little bit about like trusting a professional or using like a robo advisor, given that I think probably everyone in this audience is smart and has access to a lot of information, but not necessarily a lot of time to be spending on looking at this sort of stuff?
You're the
Sure.
Robo Queen.
I've never been called that before. That's a new title. Well, so, investing is important in making the decisions. We have a couple different categories of investors. There are people who delegate and say, I want to achieve a goal, but I don't have time, so I'm going to delegate. And in that case, having a face-to-face advisor or a video conference advisor, all of our people on video, is oftentimes one of the better solutions because you have that person as your coach, assigned with you, working with you regularly, and having the actual human relationship is very important to some people, and that is available. From there, we have a group in the middle called validators who want advice, who seek counsel, but want to do much of the things themselves. And they're not quite self-directed yet, which is the further down the continuum, but they're validators. And they want an advisor and they want to be able to get an ongoing component, but they will ultimately make those decisions on their own. And in that case, sometimes a robo-advisor plays a role in that case. And then you have your total self-directed that researches everything on their own, wants to make their own decisions. But I would also say that these three categories are not mutually exclusive for the rest of their lives. At different points in people's lives, they may go to validator and they may go to delegator. But we do see millennials tend to want to get more involved in terms of robo-advisors. And they play a very important component, but there's a continuum of robo-advisors out there. There are some that are just algorithms, and you go online or you go to your digital components and you find out how your account is performing, but you don't necessarily get to interact with a human being. There are other robo-advisors like Schwab Intelligent Portfolios where you have the algorithms, you have the rebalancing, you have the tax optimization, but you also get to talk to a human being so that as you go through life, there's someone there both in the local community or through video conference or chat or co-browse or anything that's available to you. And so I think it depends on what you want out of a relationship, but here's what I would say is that really understand the costs of each. As you think about getting advice, there's fees that you pay for that. Really understand, ask questions. What am I paying and what am I getting for this? And what does that mean on an annual basis? Is it $4,000, $10,000? What is the actual amount I'm paying for this advice? And for robo-advisors, you really want to watch that as well in terms of the understanding what you're paying and what you're getting for that. Because remember, every fee you pay cuts into what you could be investing. And so a lot of times people don't realize what they're paying, and if they're paying $4,000 or $5,000, $10,000 a year for an investment, they could be taking those dollars and reinvesting them for a much greater outcome. And it's not that complicated. Certainly at Schwab, we really ask our clients to ask more questions, understand what they're paying, understand what they're getting, be very transparent in that process. And so that's one thing I just encourage all of us. And I don't know how many of you do grocery shopping, but I'm still an old fogey that does grocery shopping. And when I go to the grocery store, I really want to know, what am I paying for this, and what's in the food, and what kind of value am I getting? I mean, I talk to my kids more about protein, carbohydrates, fats, the nutrition component, so I really understand it. And we at Schwab encourage people to be engaged in their financial services conversations just as much, so we understand what's happening, what we're paying, and ultimately what we're trying to achieve with that.
All right. Sorry, go ahead.
Oh, okay. Hi, I think your answer to my question is going to be diversification, but I'm going to ask anyway. I recently came to Google from the public sector. I was working in San Francisco, and I felt like I had a better pulse on tech stocks in general. I was reading a lot, just had my ear to the ground. I was working with a bunch of San Franciscans who lived through the dot-com bust. But now that I'm in tech, I feel like I can't see the forest for the trees. So I'm wondering if you have any thoughts on investing in the sector in which you also work.
Yeah, that's a good one. I think it goes to what is a bit more of a micro question when you are receiving some of your compensation or a big chunk of your compensation in your own company stock. How do you diversify around that, particularly because your sort of life is involved with the company, and then if your investments are there as well. And I think that's the benefit that Terri talked about in terms of the auto sales that allow you to move some of that money in other areas. That said, there's nothing wrong with investing or having a bias to an industry that you know. That said, many times what appear to be the most exciting industries or companies, you're not the first one figuring that out. So this, going back to the old sort of Peter Lynch approach of, I used to walk in the malls, and if I saw, I think he used to talk about the Gap, which I think there are people who don't even know what the Gap is anymore, but that if you see lines out the door, then that's probably a good investment. But the speed with which information flows these days and how quickly it gets digested into the valuation of companies means that unless you're the first one discovering this, fabulous company or this great product, it's already priced into the stock. So you do have to be mindful of the difference between what is obviously a great company with great products and great sales, and whether that's already reflected in the price. And again, speaking for me personally, I get a big chunk of my compensation in Schwab stock, and my husband and I are very mindful of diversifying beyond just that, because I work in financial services, and a big part of my compensation is a stock in financial services. You need to have that diversification outside of it. And so you're right, the answer is diversification.
Yeah, and I think each individual has different goals, and so at Schwab, and because we're in stock plan services, we offer equity consultations for individual employees here at Google to know, here's my particular situation, here's how I could diversify or make some of these decisions.
So we have a few minutes, 4 minutes, 5 minutes left. So last question, and then we'll just see if we have one more question from any of the offices.
So with more women controlling or having more access to wealth, are you seeing sort of any trends in being more socially conscious about how we invest? How is Charles Schwab thinking about socially conscious investing? Because when I look at sort of my own plan and long-term financial saving, it's really hard to get into even basic mutual funds without going against some of my values and how I want to invest. So can you speak maybe a little bit about trends in the market and what Charles Schwab is doing to address that?
Yeah, thanks for the question around ESG. Certainly, we do find that more and more millennials are more interested in social investing.
I'm not a millennial.
Well, you look like it, so somehow you're pulling it off. But more and more people are, and more women are. And so it's a very important cause and a very important part of our investing strategy, those things that are important to us. And again, with the longer term diversification, you can win at those successful strategies. And so at Charles Schwab, we do have ESG funds available. One of the things that I love about Charles Schwab is that we're an open architecture firm. And so you can come to us and really find the very best solutions for you, be it mutual funds or ETFs or anything that's available. It's not just Schwab, it's an array of different types of solutions that are almost at a supermarket per se. And so we have many different advised strategies around ESG, mutual funds, ETFs, and any one of our financial advisors here in this area, and we have many representatives here from Walnut Creek and from Mountain View, and they can help you look through the supermarket and find the one that's best for you longer term and for the causes that are most important.
Okay, should we see if there's a question from any of the offices that are live streaming? If not, we'll take one more question.
There's one more on the Dory. How has the recent U.S. election changed your outlook on the market, and do you have any guidance for individual investors?
So obviously, not only was the result of the election a bit of a surprise to many, I think the market's reaction was an even greater surprise. But to me, it begs the sort of the counterfactual question is, what would the market have done if Hillary Clinton had won? And I wonder, I don't have the answer any better than anybody else, whether to some degree we were poised for a rally regardless of the ultimate victor, largely because the dramatic uncertainty associated with the election, I think, held back a lot of investing. There was a lot of hedging heading into the election. There was a lot of conservative positioning. And the fact that it was simply over, even if you weren't happy with the outcome, lifted some of that uncertainty. So that might have been a factor in place that could have driven a rally regardless of the outcome. Of course, again, counterfactual, we don't know. But I think what the market is keying off of in terms of prospectively what is coming from a Trump administration may have been a shift that was going to happen regardless, which is we've been calling it a regime change, and not regime in that we moved from Democrat in the White House to Republican in the White House, but maybe more broadly and more importantly as it relates to the market, a regime change from monetary policy, the Fed, being sort of the only game in town. We've been in a slow growth economy. There's been not much done on the fiscal side, so all the sort of weight on moving levers to get the economy to go has been in the hands of not just the US Fed, but central banks globally. But there has been this shift toward we got to do more on the fiscal side, whether it's infrastructure spending, whether it's tax reform, whether it's regulatory reform. And I think the fact that some of that may occur more quickly may be some of the fundamentals that the market is keying off of post-election.
Before we go, can I just say one more thing? It has nothing to do with the election, but one of the reasons why we're here today is that when Chuck was here, there was a question in the audience about women in investing and what Charles Schwab does. And there was also a question about Elevate and Sally Krawcheck. And so we actually have an event with Sally and myself here December 6th. It's right here in Mountain View. And so I just wanted to extend that to all of you. Sorry, across the world, it's not necessarily available, but maybe coming to you someday.
All right, well, thank you very much. We could have spent hours with you all, but this is fantastic. Thank you for your time.
You're welcome.
Thank you for coming all the way from New York.
Yeah.
My pleasure.
Really
Thanks,
appreciate it.
everybody. Thanks, everybody.
All right.
Thank you.
Thank you. And thank you, guys. Thank you.